Welcome to The Explainer. Today, we're tearing down the IPO prospectus for a brand new company hitting the semiconductor market, Tianyu Semiconductor.
So with any new tech IPO, the big question is always the same, right? Is this a buy or a pass? Is this the one to jump on, or should we wait on the sidelines? Well, that's exactly what we're here to figure out. To get to an answer, we're going to put on our detective hats. We'll start with the deal itself, then we'll peel back the layers on their business. After that, it's a deep dive into the numbers, a hard look at the risks, and finally, we'll put it all together for our final verdict.
All right, first things first. Let's get into the nitty-gritty of the IPO itself. What exactly is on the table here?
So here are the headline numbers. They're aiming for a market cap of over 22 billion Hong Kong dollars. And check this out. Almost half the money they raise is going straight into expanding production. That tells you they're betting big on growth. It's also a good sign that they've locked in some cornerstone investors. These are the big fish who agree to buy in early and hold on, which usually brings a bit of stability right out of the gate.
Okay, so we know the deal structure, but what is the actual business we'd be buying a piece of? Let's take a look under the hood.
All right, so the company's whole game is built around this really cool material called silicon carbide, or SiC for short. Now, you can basically think of SiC as, well, silicon on steroids. It's tougher, way more efficient, and it can handle much higher temperatures and voltages. And that makes it a total game changer for anything that needs a lot of power. You know, like the guts of an electric vehicle or the inverters in a solar farm.
Tianyu doesn't do the whole shebang. They're specialists. Their sweet spot is something called epitaxial growth. Now, in plain English, that means they grow this incredibly pure, perfect crystal layer on top of a base wafer. It sounds technical, and it is, but it's an absolutely essential step for making the kind of high-power chips that are driving the future.
A cool business model is great, but do the numbers back it up? Is the company actually healthy? Time to run a financial checkup.
Let's start with the good news, because wow, this is pretty impressive. The company's revenue growth is just explosive. We're talking a jump of over 167% in a single year. That's a huge signal that the market is hungry for what they're selling.
But, and this is a big but, here's the other side of that story. For all that incredible growth, they still lost over $500 million RMB in 2024. That's a serious chunk of change, and it immediately makes you wonder, where is all that money going?
Okay, this chart, this is where the plot really thickens. You see that fantastic revenue number for 2023? Great. But then, bam, look at the loss for 2024. It didn't just grow, it exploded. This is what we call burning cash to grow, and they are burning a lot of it. Now, there is this tiny little sliver of green in early 2025, a small profit. And that's the multi-billion-dollar question, isn't it? Is this the beginning of a turnaround, or is it just a blip on the radar before things go south again? You know, every IPO prospectus has that section called risk factors. It's usually full of legal jargon, but it's our job to read between the lines and figure out what should actually keep an investor up at night. And you don't have to look far. The company says it right here, plain as day. They're in a tough fight. They have to keep innovating, and more importantly, they are under constant pressure when it comes to price. That's a huge admission.
So let's break that down into real-world risks. First, there's a price war going on because of oversupply in the industry, and that just destroys profit margins. Second, their fate is tied to things they can't control, like how many EVs get sold. Third, they have a track record of losing money. And finally, you've got the whole geopolitical mess with trade tensions hanging over everything. That's a lot to worry about.
So, we've looked at the company, but investing in an IPO isn't just about the business. It's also about the market itself. And in Hong Kong, there are a couple of unique rules that you absolutely have to understand because they can really impact your investment.
The first thing to know about is the gray market. Think of it as a sneak peek. It's unofficial trading that happens for a day or so before the stock actually lists. It's a fantastic, though not foolproof way to gauge what the initial demand looks like.
The other key concept is the clawback mechanism. Basically, if a ton of everyday retail investors like us rush in to subscribe, this rule kicks in. It forces the big institutions to give up some of their shares and reallocate them to the public. This can totally change the supply and demand picture on day one.
Okay, we've looked at the business, the financials, the risks, and the market itself. It is time to put all the pieces of the puzzle together and make a call.
When you lay it all out, it's a classic battle. On the one hand, you've got this incredible growth in a technology that is clearly the future. On the other hand, you have a company that's been losing a ton of money in an industry that's currently beating itself up with a price war. This is the definition of a high-risk, high-reward scenario. So, after weighing everything, our final verdict is in, and it's a clear one. We recommend not subscribing to this IPO.
And let me be crystal clear about why we've come to this conclusion. First, that massive loss in 2024 just screams that their path to making consistent money is a long and uncertain one. Second, the industry headwinds are just too strong right now. Jumping into a brutal price war as a new public company is a recipe for trouble. And finally, when you look at the price they're asking for this IPO and weigh it against all those risks, well, it just doesn't feel like a good deal for a new investor.
Which really leaves us with one final thought to chew on. In an industry that's all about cutting-edge tech, but also cutthroat competition, how much of a safety net is really there for someone buying in at the IPO price? Right now, for Tianyu Semiconductor, it feels like there isn't much of one at all.